Hello, I'm Steve Lentz with Discover Options and welcome to the Prepared Mind. What we'll do today is go over the S&P 500 Condor Butterfly Timing Report for Monday, May 8th, where we try and inform you about the notion of whether you have an edge or not in entering butterflies and condors related to the current market condition. Okay, we like to look at the current market condition and see if it's a good time to put on a butterfly or condor. That's what we're doing here. If you like what you see at the end, you can always subscribe to us by clicking on the button below. Now, this blog entry, the video blog, coincides with the Prepared Mind text entry at the Discover Options site. Click the blog button and you'll see Frank Fahey's excellent entry there, including a nice list of double calendar candidates related to earnings. Before we get to the report, if you're interested at all in a free book we offer, you can click on the link at the top right. This is the Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Okay, the market currently is a little bit on a downward trend, moving towards its 60-day simple moving average. We could see that Friday's low and high were both lower than Thursday's lows and highs, low and high. However, it was an up close. Okay, and the stochastics are very low, starting to turn up, but still underneath the 3-day average. So we're definitely in the oversold area there. Very unique setup. Okay, stochastic low, we're above the 60 moving average, yet we have and we have the bars, a down, basically a down phase there from Thursday's highs and lows. Unique little setup here. So what we're going to do is take this exact condition and go over it in the timing report just to see if it's a good time to put on a butterfly or condor at this point. Here's our methodology, folks. We look at the 21-day actual percent move. Okay, from any close moving forward. Of course, the recent closes, we can't really determine what the 21-day actual move is because the 21 days hasn't finished yet for the last 20 bars. Okay, but previous, you can kind of see where we're, back then it was moving around. We've seen moves roughly 2 to 3, 4% or so. Okay, kind of low. It's been, not moving that much from a 21-day standpoint. The 21-day implied move from the VIX, and we skew adjusted, of course, you can see lately has been a bit higher than the actual. Okay, when you go back to March going into April, those were overvalued options at that time, as it turned out. What we like to do here is paint the bars blue when we have a favorable bar like that, where the implied volatility is higher than the actual, what actually came to pass. Now, in those moments where the actual is higher than what was implied at the time, we paint those bars red. So it would have behooved us to done condors and butters when the bars ended up being blue, and then avoided them when the bars ended up being red. Real simple. So since January of 2000, what percentage of the bars have been favorable for selling premium? Okay, when you run those numbers and look at it, it's roughly 67%, roughly 2/3. Okay, roughly 2/3. Now, of those bars which align with our current technical scenario, what percentage are favorable? You see where we're going with this? Okay, we're going to look at our exact technical scenario here, and we're going to go back in time all the way to January of 2000 and ask, of all these bars, just like the red one here, with the same condition, how many of those ended up turning out blue, and what's the percentage that ended up turning up red? Okay, because if all of them ended up turning up blue, well, then we're good to go. Of course, we're going to put on a condor or butterfly. Okay, it turned out that the market didn't move as much as was implied. But if they're all red, we're going to avoid that, of course. Okay, so before we get to the exact statistics, make sure you understand, I want to make sure you understand, you can go to the Discover Options site, check out our services. We offer continuing education, a great way for you to dip your toe in the water to see what our education program is all about. And you can kind of get a feel for kind of the research we're doing here. Every Tuesday at 11 a.m., I do an Inside Wire broadcast live for our students who want to see some of this more advanced type research. Several topics you can see down there on the list, 300 to 400 presentations that are archived for you to peruse. Directional, non-directional stuff, good stuff you'll want to check out. Here are the results. Okay, For this setup that we have, ending on Friday, you can go back in time, and there's about 64 of them going back to January of 2000. 64 times this same setup occurred. Of those 64 same setup signals, 70.3% of them ended up being blue bars, which are favorable for doing condors. 70.3 is higher than the 67, so we have an edge of about 3.3% of the 3.3%. Okay, so we technically have an edge. It's better than a coin toss in terms of whether it's a good time to put a butterfly or condor on. At least that's is what the statistics will tell us. Okay, so that is the condor butterfly timing report for Monday, May 9th, 2016. I want to show you a hedged bull put spread opportunity that we have in the S&Ps. If you take a look at that setup, some of you might look at that and call that a divergent bar. Big swing, overall long trend moving upward, trend coming downward in the short term with a new low and a higher close. That's kind of what we have here. And if it turns out to be bullish, well, if we're going to put on a butterfly or condor, we might want to lean it bullish a little bit, right? So here's kind of a situation we can look at here. The skew adjusted downward VIX. If the VIX is at 14.7, we run it through the SIBO skew. We run it through an algorithm to come up with a downside predicted movement of 16.3. The downside VIX, we call it. The upside VIX is at 13.2. Let's look at a hedged bull put spread. We're going to go out of the money a standard deviation in the puts. We come up here and we put in that, in option view, we go 16.3%. That is our volatility input to then determine the one standard deviation level. We're going to sell premium out here, a standard deviation from Friday's close. And then we hedge that with a little bear put spread here right at the money. So we pay a little bit for the short deltas here, and we're going to sell a bunch of premium down here. And when we put this all together, it looks just like this. No matter how far the market goes up, we can make money, roughly 5%. If it goes down, that hedge starts kicking in, and we can make actually a bit more money, about 3 times if we go to expiration there. But if it does challenge us on the downside, at least we have some leeway here and to a lot of room for error on the downside with that hedge kicking in. All right, so that's the trade idea using the timing report. Folks, I'm Steve Lentz with Discover Options. We'd love to hear from you. Check out the website. Check out our continuing ed. Get the free book if you want. Thanks for joining us. We'll talk to you next week. Thanks. Bye-bye.